The ability for the stock market to rise and fall has been no more apparent than over the last 6 to 12 months, as we've come out of COVID and seen interest rates rise, potential recession looming, and a cost of living crisis. In the recent weeks, we've had an Alphabet 20-to-1 stock split. We've also had Tesla's Q2 earnings, which exceeded expectations in some sense, and both of these have had large impacts on the overall value of my portfolio. My last update was back in November of 2021, and at that point we had started to see the effects of rising inflation, but we didn't know the effect it was going to have on our entire cost of living, and we couldn't have predicted how bad it could get. Governments and central banks are now trying to react to this, but they could have done a lot more a lot sooner. And by raising interest rates now, they're hoping to slow that rate of inflation back to around 2 to 2.5%. But of course, we're right in the middle of it at the moment, and we don't know how effective these changes are going to be or how quickly they could potentially have the effect they're looking for. All of this and the uncertainty can be seen when we have a look at my Trading 212 portfolio. So we can see over here, the total value of my portfolio is currently £4,060.85. So it's very, very similar to what it was when I last did my update. But you can see, if we look at the last year, it rose quite substantially throughout 2021, which was largely a positive time. And this peaked around November sort of time. And as you can see in the graph, it's kind of traded sideways since then. Yes, we've had pullbacks, relatively large pullbacks, which obviously we've all experienced within the market, before rises again, pullbacks, and overall we've kind of traded relatively sideways, or at least my portfolio has done. A lot of the companies within my portfolio are not specifically targeted at growth. And I think that's one of the reasons why my portfolio has managed to maintain that kind of equal level of growth, kind of trading sideways, rather than seeing some of the massive losses that we've seen in particular companies of 80-90%. Since Alphabet's stock split, I now own 3 shares in Alphabet, which is valued at £290-ish. I'm currently up 17% within this investment, but if we scroll down over here and click on this little information icon, you can see that much of this return that I'm seeing at the moment is actually coming from the FX impact, and this is because the dollar is relatively strong at the moment when compared to the British pound. I now also hold 2.4 shares in Amazon. Now, Amazon also went through a 20-to-1 share split. It has been struggling somewhat over the last year, with it being down currently 30.49%. If we have a look at my investment, I've currently got £252 invested in Amazon, which is netting me a negative £15 return, or a loss of around 5.5%. If we hop in and have a look at the return again, you can see the FX impact, I'm actually up 10%, so it could be a lot worse than it actually is. Amazon is, of course, a massive multinational company, and it's not one that I am particularly worried about right now. While it is a diversified company, its core business is still in internet retail, which means that it is susceptible to the rising cost of living and inflation as well. With cost of living rising, people are less likely to spend money on things that they don't really need. So lots of people do buy random things on Amazon, which of course increases Amazon profits and makes them a more profitable company, rising the stock price. So as the economy starts to slow down and people have to start to spend more money on clothing, heating and food, we're going to see companies in the retail space pull back slightly. The next company is Apple, and I currently hold 3 shares in Apple. Over the last year, they're up around 7%. They've managed to do fairly well throughout what's been a relatively challenging time. We'll have a look at my return. I'm currently up £115 on this investment, or 40 to 41%. AT&T, one of my biggest losers within my portfolio. I currently own 9.5 shares of the company. AT&T has done very poorly for me over the last year or so. Lots of people invest in AT&T for the large dividend, and you can see here they still pay out a dividend yield of 5.42%. However, it has got some people questioning, is that enough to hold on to a company which has performed consistently poorly for a substantial amount of time now, really? If we go back over the maximum chart, you can see it is on a downward trend from ever since back in kind of 2016. This is a company that I am going to review its position within my portfolio. I've currently got £150 invested in AT&T, which, as I've said, is down £57, or around 28%. The next company is BAE Systems. Now, I did sell a little chunk of BAE about a month ago. Of course, because of what BAE Systems are and the products that they sell, global conflicts usually see defensive stocks like this perform fairly well. They've currently got a share price of £7.81 per share, and I've got an average buy price in of around £4.80. So I'm up around £3 per share in this company. I've currently got 26 shares. As I said, I did sell 6 of them fairly recently, with a total amount invested of £209.48. This is currently netting me a return of £81.80, or 64%. We've then got Coca-Cola, a staple of lots of different people's investment portfolios. I'm currently up 32.5%, or £73. My total investment here is just under £300, and I own 5.8 shares in the company. We've then got the Ishares Global Clean Energy. Now, this is an ETF that I see as being very important, not just for my portfolio, but for the general well-being of the environment and the climate. I currently hold 18 units of this fund, 18.7, with a total invested cash of £177.07. I'm currently up £7.85, or 4.5%. We're then on to Johnson & Johnson. You can see here, over the maximum period of time, nice, steady upwards trend over time, which is a great company to be invested in. It's also a dividend payer, paying a dividend of 2.65%, which gives me some much needed capital into my portfolio. I only hold 1.4 shares in the company with a total value of just over £200 at the moment. I am up £38.83, or 24%. And again, you can see that that gain is split very equally, almost exactly equally actually, between the capital growth of the company and the FX changes as well. Microsoft is a company I think should be in everybody's portfolio. Again, you can see this has grown over time. If you flick across the year, you can see it's actually not had a particularly good year, with it being down just over, or just under, 6%. I currently hold £188 within this company, which has given me a rate of return of 31.3%, or £45. Nvidia is one of the newer companies to my portfolio. I bought just before it took a bit of a dip, but Nvidia is going to be a central company to lots of the development of technology over the next 10, 15, 20 years. So it is on sale a little bit at the moment. Could be an opportunity to buy some more in. It does pay a very, very small dividend of 0.1%, so you're not really investing in it for that. You're investing really for the growth in the share price. I'm currently down £11, or 12.7%. I currently hold half a share, which equates to £76.60 of invested capital. We're then into Pfizer, which of course had a fairly good time because of the COVID vaccination and the large-scale adoption of the Pfizer vaccine. Over the last year, it's up 24.64%, with a current share price of $51. I currently hold 4.81 shares in the company, which equates to £206, and I'm currently up 45.63%. We're then into Realty Income. It's traded over the last year relatively flat. You can see here it's up only 0.5%, but I've continued to get that dividend yield, which is very, very nice indeed, of 4.23%. So whilst it has traded sideways at 0.5%, I have actually received 4.23% as well. So swings and roundabouts, really, the benefits of investing in a dividend company. I currently own 5.5 shares of this company, which are valued at £325. I'm up around 25%, or £64, and again, you can see the breakdown there, very even between the two. Rio Tinto is my newest investment in this portfolio. I'm going to probably do a little bit of a breakdown video at some point on Rio Tinto and the reasons for investing into them. I currently own 1.8 shares in the company, which are valued at £86, and since investing in them about a month ago, I'm down around 7%. Shell is the next company, and one that I have held on to since starting this portfolio. And because this one changed its name and its ticker symbol, annoyingly, trading 2-on-2 doesn't actually give me a rate of return for this. So I'd have to go in and do a little bit more calculation. As you can see here, it shows my average price of absolutely free. So a little bit frustrating from trading 2-on-2 there. Starbucks down 10% overall, and you can see over the last year it's performed very poorly. And I guess with the rising cost of living, people are less likely to go out and buy coffees, go out to kind of have meals and food. So that is one of the reasons why Starbucks is getting hit a little bit. Tesla obviously had their earnings call yesterday, so earlier this week. So you can see this nice jump here is because it performed very, very well. There are still some grey areas regarding the earnings call, but largely the stock market has responded very positively to it. So you can see this week alone it is up 14%, and yesterday it was up just a little under 10%. I currently hold just over 1 share in Tesla, which is valued at £683. I'm up £316 on this investment. It is my largest holding at the moment, and I have made a rate of return of £86, and you can see here the breakdown again of that investment return. The final company is then Unilever, a nice UK company. One that I actually received as free shares to start with, but then I decided to start to invest in. I currently own 4 shares within Unilever. I'm down just over 2.5% with a total investment of £156. You can see over here the total realised profit or loss is currently down £27.19. Dividends, I've made £94.89 and total deposits of just over £3,000, but as we've discussed, that factors in any free cash that I've been given from free shares as well from the sign-up system. So then I'm finishing this update. My portfolio is currently valued at £4,057, netting me a rate of return of just under £950, with a rate of return of just over 30.5%. As always, if you do enjoy videos like this, please don't forget to drop a like on the video down below and comment to let me know your thoughts on my portfolio, and also let me know how your portfolio is getting on. And of course, please do consider subscribing to the channel if you haven't done so already. And with that said guys, thank you very much for watching this update video on my Trading 212 portfolio. Got lots more content coming very soon because I've now got the summer off. So I'll catch you soon in the next one.